Yes.
All right. I hope everybody is doing good. Let's start. Shall we start if you all are ready?
Yes.
Yes,
Today I have special episode to cover, and this is because we are going to roll out new feature on Rift this week. Today we will cover a bonus episode on Rift before you quit about prediction markets. And today we will learn what are prediction market, what is prediction market, and then in the next bonus episode we will understand what we have built on Rift. Perfect. So prediction markets. How markets convert uncertainty into tradable probability. Financial markets have always attempted to answer questions about the future. Traders analyze charts to predict price movements, economists study data to forecast inflation. Investors evaluate companies to estimate future earnings. Governments model economic activity to anticipate policy outcomes. But the most traditional markets do not trade the future event itself. They trade assets that may be affected by that event. Prediction markets introduce different model. Instead of asking how could this event affect the market, a prediction market asks what probability does the market assign to the event actually happening. Will Bitcoin settle above defined price? Will a central bank raise interest rates? Will inflation exceed a specific percentage? Will a particular candidate win an election? Will a team become next world champion? These questions can be transformed into tradable contracts. Participants buy and sell position linked to these possible outcomes. As opinions, information, and market conditions change, the price of each outcome changes with them. The result is a continuously updating market generated probability. Prediction markets therefore operate at the intersection of financial trading, forecasting, information aggregation, probability theory, behavioral economics, risk management, and market infrastructure. They are not simply betting interfaces. At their most advanced, prediction markets are mechanisms for discovering what a financially incentivized crowd collectively believes about an uncertain future. In this episode, we will explore what prediction markets are, how outcome contracts work, why prices can be interpreted as probabilities, how liquidity and information affect accuracy, the main types of prediction markets, how leading platforms approach the industry, what makes a reliable market, and why prediction markets may become an important layer of future financial infrastructure. And this is all not a concept, this is already built, developed, and deployed, is live on Rift already. So, and I'm explaining this after pushing it, making it ready. That is why we are very much ahead in terms of development when it comes to Rift, and we are very careful in deploying all the features. So today is the first day as the introduction of the new feature of prediction market on Rift. This is an additional industry that we have included alongside trading on Rift. So let's learn and understand what is prediction market, and slowly and gradually we will move towards what we have built on hyperliquid infrastructure of HIP4 on Rift. What is a prediction market? A prediction market is a marketplace in which participants trade contracts linked to the outcome of a future event. A prediction market, the event must have a clearly defined question, one or more possible outcomes, a defined closing or settlement time, and an objective resolution method. For example, will Bitcoin be above $70,000 at 4 p.m. UTC on a specified date? The market may contain two outcome contracts. Participants who believe Bitcoin will finish above the threshold may purchase the yes outcome. Participant who believe it will not may purchase the no outcome. The prices of these positions change according to supply and demand. If more participants become confident that event will occur, demand for the yes contract may rise. If new information weakens that expectation, the yes price may fall and the no price may rise. This means that a prediction market does not produce a fixed forecast. It produces a live tradable forecast that changes as information changes. The market is therefore both a trading environment and an information discovery mechanism. This distinction is important. A poll asks people what they believe. A prediction market asks participants to financially act on what they believe. Because capital is at risk, participants have an incentive to research the event, identify mispriced probabilities, react quickly to new information, and challenge inaccurate market consensus. Real world comparison. Imagine that 10 analysts are asked whether inflation will exceed 4%. A traditional survey may record 6 analysts saying yes, 4 analysts saying no. The results suggest that most analysts expect inflation above 4%. However, the survey does not show how confident each analyst is, how much evidence supports each view, whether one analyst has stronger information, or whether opinions have changed since the survey was conducted. A prediction market adds another layer. Participants can express the strength of their conviction through market positions. Someone with weak confidence may commit little capital, someone who identifies a major pricing error may commit more. As participants trade, the market price becomes weighted, result of competing views, information, conviction, and available capital. Poll versus prediction market. Poll is about question is asked, opinions are collected, responses are counted, and the results are static. Whereas prediction market is question are listed, capital is committed, positions are traded, prices continuously update, and there is dynamic probability of yes and no. Polls measure stated opinion, prediction markets measure financially expressed conviction. How outcome contracts work. The basic building block of prediction market is the outcome contract. An outcome contract represents a claim on a particular result. In a binary market, a contract normally resolves to one of two values: the maximum settlement value if the outcome is correct, or zero if the outcome is incorrect. For example, imagine that a yes contract cost 60 cent and pays $1 if the event occurs. A participant who buys the contract risks 60 cent. If the event resolves yes, the position receives $1. The gross difference is 40 cents before fees and other costs. If the event resolves no, yes contract settles at zero. The participant loses the amount paid for that contract. The no contract represents the opposite result. In a well structured binary market, yes and no prices are closely connected because one of the two outcomes must resolve successfully. This creates a bounded payoff system. The participant knows the entry cost, the maximum possible payout, the event definition, and settlement condition. This is different from an open ended futures position where profits and losses depend on how far an asset price moves. Prediction market contracts often have defined maximum outcomes. Market question. Let's take a simple payoff example. Will Ethereum settle above $2,000 tomorrow at 1200 UTC? If yes, in 65 cents, if no, then 35 cents. A participant purchases 100 yes contracts. Total cost is 100 multiplied by 65 cents, that is $65. If each settles above 2000, then settlement value is 100 multiplied by $1, that is $100. Gross gain is 100 minus 65, that is $35. If ETH does not settle above 2000, then settlement value is zero. Gross loss is $65.
Như vậy là sẽ bị lỗ là 65 đô đấy ạ.
This structure makes the risk and reward visible before the event is resolved. This is a binary outcome contract. If yes wins, then payout will be settled at 1. If it does not win, then payout will be settled at 0. Why market prices look like probabilities? One of the most important features of prediction market is that contract prices are often interpreted as implied probabilities. If a yes contract trades at 70 cents in a market that settles at $1, the market may be interpreted as assigning approximately 70% probability to the event. The price is not a scientific guarantee that the true probability is exactly 70%. It is the current market clearing price at which buyers and sellers are willing to trade. That price can be influenced by available information, participant expectations, liquidity, transaction costs, market imbalance, emotional behavior, large traders, and platform design. Therefore, the market price is best described as market implied probability, not objective certainty. This distinction matters. If a contract trades at 70 cents and the event later fails, that does not necessarily mean that the market was irrational. An event with a genuine 70% probability should still fail approximately 30% of the time across many comparable cases. Probability is not certainty. A high probability event can fail. A low probability event can occur. Prediction markets measure uncertainty rather than eliminate it. Probability and expected value. Sophisticated participants do not simply ask, "Do I think this will happen?" They ask, "Is the market price lower or higher than my estimated probability?" Suppose a yes contract cost 55 cents. The market implies probability is approximately 55%. But the trader's independent analysis estimates that a 68% chance of event occurring. The trader may view the yes contract as underpriced. A simplified expected value calculation would be estimated probability multiplied by settlement payout, that is 68 cent multiplied by $1 is $68, and market cost is 55 cents, so estimated value difference is 13 cents per contract. This does not guarantee profit. Traders' probability estimate may be wrong, but it shows how prediction market participants evaluate pricing. They are not only forecasting the event, they are comparing their forecast with market's forecast. How traders identify possible mispricing. Market price compared with possible difference identified, and that's how they make the trade decision, and that's how they do this in a risk managed environment. The opportunity is not merely predicting the event, it is identifying whether the market probability is mispriced. Information aggregation and the wisdom of markets. Prediction, should we stop here and continue the rest from Monday, from
Hôm
Wednesday,
nay,
Friday? I think it will be too much for one day because this is a new concept.
yes.
So we continue from here on Friday, but this feature is completely ready and it is ready to go live within this week. Okay, along with continuation of prediction market episode, we will have the special announcement also on Friday. So make sure that everybody joins Friday call. Perfect.
Yes.
Thank you.
Yes, thank you.
Thank
Thank you.
you.
Thank
Thank
you,
you.
see you. Thank you, see you.